Losses are soaring. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the major banks kicked off earnings seasons, and Goldman Sachs shocked the market with a continuation of billions in losses in its consumer division. And while other bank CEOs said it's not a big deal and everything looks rosy, underneath the covers, they too are bracing for more losses. And later in today's show, I'm going to show you why these losses the banks are posting are just the beginning. Let's head over to Bloomberg, where we picked today's story up. With Goldman lost a whopping $1.2 billion in just 9 months in its newest unit. The disclosures offer guide to Apple Card impact on earnings. The collection of businesses, including Goldman's Apple Card, now packaged into the segment dubbed Platform Solutions, racked up more than $1.2 billion in pre-tax losses in last year's first 9 months, with a drop accelerating every quarter. So the key here isn't that they just took a whopping $1.2 billion loss in the first 9 months. It's that the losses are accelerating. And this is not something you would want to hear in a recovering economy or an expanding economy. What you hear this in is a slowing economy where things are getting worse for consumers. From the start of 2020 through the end of September, Platform Solutions pre-tax losses have piled up to a whopping $3 billion. When the latest quarter's figures get added to next week, the cumulative loss will approach $4 billion in the 3-year span and $2 billion for the year, driven by loan loss provisions. And now we're starting to see that here again, despite all this pandemic money, low interest rates, what we're starting to really learn is the economy going into the pandemic was just what we thought. It was headed into recession. Not everybody benefited from all of this fiscal and monetary stimulus. Some people faced the choice to charge it, and now they're facing charge-offs because they can't make the payments. The Platform Solutions provisions in the first 9 months of 2020 totaled $942 million. At a time when charge-off rates have been historically low, Goldman has said that rate for its consumer lending business, get this, has climbed to an annualized mark of 2.9% after the period ended in September. So again, here you can see that charge-off rates, this is where banks say, you know what, we're pretty much convinced that you're not going to pay us back. We can't get any more money from you, so we're going to take it at a loss. You see that number is increasing. Now we're going to note as we get into the other bank earnings here that the numbers remain very low historically, but I'm going to give you the case of why these numbers are going to head a lot higher, and the banks actually know it. The division's $1 billion pre-tax loss reported for 2021 was mostly tied up in, get this, the Apple Card. And about $2 billion in 2022 mainly stems from Apple Card and installment lending platform GreenSky. So here you can see people who desperately needed credit, wanted to buy things they couldn't afford. Well, they went to the Apple Card, Goldman gave them the credit, and now they're stiffing the bank saying, we can't pay. And now let's head over to JPMorgan. Again, I want you to see how Jamie Dimon, I want you to see how the report says everything's okay. But again, underneath the covers, they're looking at what's going on at Goldman, and they know it's coming their way. JPMorgan falls as net investment income forecast misses analyst estimates. The U.S. economy, get this, currently remains strong with consumers still spending excess cash and businesses healthy, according to CEO Jamie Dimon. Now, again, you look over to Goldman and you say, wow, $1.2 billion loss in the first 9 months of this year. How does that translate over to what's going on at JPMorgan to say, hey, everything's okay? Is Goldman just that bad at issuing credit card and JPMorgan is that much better? Or is Jamie Dimon just trying to cover up what he knows is going to get worse? However, we still do not know the ultimate effect of the headwinds that are coming. There you have it. The company also warned of a modest deterioration in its macroeconomic outlook. But here underneath the covers, look at what they're doing. Not what they say, it's what they're doing. But the bank posted a $2.3 billion provision for credit losses in the quarter, a 49% increase from the third quarter that exceeded the $1.96 billion estimate set aside for expected defaults. And that's the key point. So when you see the term, they're putting money into credit loss reserves, what the banks are doing is saying, look, we are the ones extending this credit out there. If someone defaults, we're on the hook. So what they're doing is they're taking their own money because they believe these defaults are coming, and they're putting it into reserve for when it happens. The move was driven by a modest deterioration, and I don't know about you, but $2.3 billion doesn't sound modest in the firm's macroeconomic outlook, now reflecting a mild recession in the central case, as well as loan growth from customers using their Chase credit cards. So if this gets worse, if the banks perceive that a recession is going to get worse, and now again, everybody seems to now agree that we're going to see a recession in 2023, what we need to be watching in the future here is if the banks start massively increasing their loan loss reserves. If they do, it's a sign they already know their customers aren't going to pay. And you think about it, who better to know about the financial health of their customers than the bank? They see when they lose their job, they see how much money they have, they see all the loans they have, they see their ability to pay. And when they see that deteriorate, they're the ones who have to put money away. And now let's turn to Bank of America, who tops expectations as higher rates help offset declines in investment banking. Again, a great headline, but get this, investors will be eager to see how the CEO describes the state of the bank's retail and business customers. The bank implemented, here we go, $1.1 billion provision for credit losses, up $1.6 billion compared with the same quarter 2021, but said its net charge-off remained below pre-pandemic levels. So here you see again, they're raising the amount of cash again in case of defaults, but acting like, hey, it's no big deal. We just think that we need to put a little bit more money here, and don't get panicked. Don't worry about it. It's still well below the pre-pandemic levels, so there's nothing to worry about until we get to the point where I show you that they really know the number is going to go higher, and they're actually getting worried about it. Now, let's turn to Citigroup. Citigroup's fourth quarter profit declines by a whopping 21% as the bank set aside more money for credit losses. The bank said it set aside more money for credit losses going forward, increasing provisions 35% from previous quarter to $1.85 billion. This build included a $640 million for unfunded commitments due to loan growth in the private bank. So here you see it again. Hey, everything is okay. We're just taking some precautionary measures here in case we have, a mild recession. We know this is likely to happen, and we just want to make sure. But underneath, again, I'm going to show you now why they're actually going to continue to increase these loan loss reserves, because this is only the beginning, my friends, of what is coming from the banks in terms of people defaulting on their loans. So where do we need to start with this part of the story? Well, is a chart we're all familiar with. This is a 4-week moving average of initial claims, and I wanted to show it to you just by itself because on the next slide, and I want you to see as claims rise going into a recession, and obviously we know the Fed is slowing the economy down. They want to see people lose their job. We know this for a fact, but now look what happens when we overlay the charge-off rate on credit cards at all commercial banks in red. And with no surprise, none whatsoever, we should expect to see as initial claims rise, people can't make payments on their credit cards. No shock to this data point at all. And as claims fall, of course, fewer people need to charge or need to write off their credit cards because they can make the payment here. So now the question is, well, Steve, you might be saying is the 4-week moving average is pretty low. The initial claims, you talked about it yesterday, they're historically low. That's exactly the point. The banks know this number is going to go higher, and it's going to happen soon. So now let's take you to some preliminary data that came out today as we kind of build in the story of why this is just the beginning. And today we got the University of Michigan preliminary consumer sentiment expectations and current conditions. We have all that data, and we note that expectations rose slightly. So that means expectation is looking down the road, consumers are a little more optimistic. I'll show you why, what is the real driver of that. Current sentiment rose, meaning they're feeling a little bit better, and current conditions. So we can think about current conditions as why is that remaining low? And that's likely because unemployment claims are staying low, and that means consumers are optimistic because if they have their job, that means they can still keep going. If they lose their job, their optimism tends to go way down. And here you can see the relationship now, the University of Michigan consumer sentiment in blue. Again, this does not factor the preliminary data against the charge-off rate on credit cards. Has come full circle to why this is a beginning. And what we can see and what we should expect is when consumer sentiment crashes, charge-off rates go up. And we can generally see that happening. Now, even there's mild times when sentiment falls a little bit and charge-off rates go higher. But typically when you see a big decline in sentiment, charge-off rates go up. Again, it comes back to the jobs market, but this time we saw a big drop in sentiment in the pandemic, but charge-off rates didn't go down. And here's what I want you to think about. The reason they didn't go down was not because the economy got shut down, was because, of course, all the fiscal stimulus, so people could afford to make those payments. Now let's go back and look a little bit deeper. We see again here that, of course, the sentiment came crashing down. Charge-off rates went down yet again because there was still money in the bank. And that's the thing that I want to point out. The banks know how much money people have. They know when they're running low. And that's why we're starting to see them raise, of course, their loan loss reserves. But what is that little pickup in sentiment that I wanted to point out to you? Well, it's all due to stocks. And here you can see the University of Michigan Consumer Sentiment Survey is highly correlated to the Wilshire 5000 among other data series. But when it comes to current expectations, we know when the stock market, at least shown here on a year-over-year rate of change, looks like it's starting to bottom out. At least that's what the sentiment data is seeing. Well, people suddenly get more optimistic about their future. But as far as the banks go, and that's what I wanted you to see today, they're acting like everything's okay. But we'll see by the end of this first quarter, if they're massively raising those loan loss reserves, it's because their phrase of it will be a modest recession. No, they know it's going to be worse. They just don't know it yet. But they're going to be on the firing line when all these people default. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.